Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Let's kick things off with a topic that's been weighing heavily on the Canadian housing market, housing affordability. According to new data from the Canada Mortgage and Housing Corporation, or CMHC, housing affordability in Canada is getting worse. Federal records reveal a slowdown in housing starts in the country's largest cities, which has left the national growth rate flat in the first half of this year.
That's right, Sandy. Toronto, in particular, is on track for its lowest number of housing starts in 3 decades. This is a significant development considering the city's rapid population growth, which has outpaced other G7 nations. The federal documents indicate that this growth is compounding pressures and costs for communities, making it increasingly difficult for people to find affordable places to live.
It's concerning, Steve, especially for vulnerable populations and lower-income households who are struggling to meet their basic housing needs. The lack of suitable affordable housing is forcing many middle-class Canadians to remain in rental units longer, which places additional pressure on rental supply and drives up rental costs.
And let's not forget the economic implications. The document suggests that costly housing is hurting the economy. With middle-class Canadians staying in rentals longer, there's less movement in the housing market, which can stifle economic growth. The federal government is planning to launch a new agency, Build Canada Homes, to speed up affordable home building and encourage the adoption of new technologies in construction.
That's a step in the right direction, Steve. But it's clear that the government has some catching up to do, especially since the cost of constructing residential buildings in Canada has increased by 58% since 2020, partly due to tariffs imposed by the United States. This shortfall is particularly affecting newcomers and vulnerable Canadians.
Indeed, Sandy. The documents also highlight that the stock of non-market affordable homes in Canada is only 4% of the total housing mix, which is below the Organization for Economic Cooperation and Development's average of 7%. This is contributing to an increase in average nightly homeless shelter use, which rose by 43% between 2020 and 2023.
The federal government is under pressure to address these issues quickly. Prime Minister Mark Carney has announced that the new Build Canada Homes Agency will be launched soon, aiming to ramp up the pace of affordable home building. It's a critical initiative, considering the barriers to ending homelessness, and the increasing lengths of shelter stays highlighted in the briefing materials.
Absolutely, Sandy. As these developments unfold, we'll continue to monitor the situation closely and provide updates on how these initiatives impact housing affordability and the broader real estate market in Canada. It's crucial for us to keep our listeners informed so they can make well-informed decisions.
Let's switch gears and talk about an interesting development in Toronto's housing market. While it's certainly a challenging time for investors and landlords due to falling prices and rents, there's a silver lining for first-time buyers. Recent data shows the market is opening up opportunities for those who were previously on the sidelines.
That's right, Sandy. It seems like the price drop in Toronto might be bad news for some, but it's offering a glimmer of hope for first-time buyers. Detached home prices in the Greater Toronto Area have fallen by 7.5% year over year, with semi-detached and townhouse values also seeing declines. Leah Zlatkin, the chief operating officer and broker at Mortgage Outlet, mentioned that many first-time buyers are finally able to make a move in this cooler market.
It's a refreshing change, Steve. We've seen buyers who have been waiting for years now finding opportunities, especially in townhomes and row homes. Zlatkin mentioned that these are priced reasonably, making them affordable for those entering the market for the first time. It's a great news story for first-time homebuyers, providing them with a chance to own a home.
Absolutely. and it's not just within the city. Smaller markets outside Toronto, like Tottenham, North Aurora, and East Gwillimbury, are becoming attractive options for buyers. They can purchase homes around the $750,000 mark and still commute to the city via the GO train. Plus, the bidding wars that drove prices up during the pandemic have cooled off, making the process less daunting for new buyers.
It's encouraging to see these changes, but it's important to note that core living in Toronto remains out of reach for many workers, especially those earning between $70,000 and $140,000 annually. Chris Allard from Smart Debt Mortgages pointed out that despite some federal and municipal employees returning to the office, affordability is still a challenge in the core areas.
True, Sandy, but the outlook seems positive for now. There's little evidence of a price rebound in Toronto, and with the Bank of Canada expected to lower rates soon, it could make financing even more accessible. Leah Zlatkin also noted that bond yields are down, which typically signals a decrease in rates, although we're still waiting to see that happen.
That's a good point, Steve. We're in a bit of a holding pattern at the moment, but this stability offers first-time buyers a chance to enter the market while it's still accessible. It's a rare opportunity in a city like Toronto where the market is usually so competitive.
And with the Canadian Mortgage Summit coming up, it'll be interesting to see what insights emerge from industry leaders. Leah Zlatkin will be moderating a panel discussing the outlook for brokers and borrowers in 2026, focusing on trends and strategies to help clients navigate potential challenges.
Let's dive into a concerning trend we're seeing in the Canadian banking sector: mortgage arrears among the Big Six banks. Recently, the Canadian Bankers Association reported that these arrears have climbed to multi-year highs. Historically, these banks have maintained a low-risk approach, but recent filings show a significant uptick in arrears rates.
That's right, Sandy. The arrears rate climbed to 23 basis points in June, which is a 21% increase from last year. While it may not seem alarming at first glance, this jump is the highest we've seen since February 2021. It signals a potential erosion of credit quality on a national level.
And what's more concerning is that 5 of the Big Six banks have residential mortgage arrears that are higher than the national average reported by the Canadian Bankers Association. For instance, BMO tops the list with an arrears rate of 37 basis points, followed by CIBC and RBC. TD is the only bank outperforming the average, with an arrears rate of just 13 basis points.
Exactly, Sandy. The velocity of change is what's really catching our attention. The National Bank saw a 59% increase in arrears, BMO 54%, and TD 44%. These numbers indicate that the market is not just underperforming but actively deteriorating. It's important to monitor these shifts closely.
It raises the question of whether this is a sign of household financial stress or an investor-driven issue. Given that the Big Six banks tend to cater to higher-income households with stable incomes, it's unusual to see them leading in arrears growth. Some suggest that investors, particularly those involved in new construction condo apartments, might be driving this trend.
That could be a factor, Sandy. The Canadian bank regulator has delayed adopting Basel III risk standards, which would change how banks assess the risk of non-owner-occupied homes, considering them 50% more risky. This delay hints at potential vulnerabilities in the investor segment, especially since these condos are often cash flow negative.
It's a complex issue, Steve, and the implications could be significant for the broader real estate market. As we continue to analyze these developments, we will keep our listeners updated on the potential ramifications for both investors and regular homeowners.
Absolutely, Sandy. It's crucial for our listeners to stay informed about these trends. Understanding the dynamics at play can help them make more strategic decisions in this ever-evolving market landscape.
Let's talk about a situation that's causing quite a stir in Ontario's real estate sector. The Real Estate Council of Ontario, or RECO, is seeking a court injunction to freeze the assets of iPro Realty and its former principals due to an alleged multi-million-dollar shortfall. This is a significant move as RECO continues to investigate the matter.
That's right, Sandy. RECO has filed a notice of application with the Ontario Superior Court of Justice, aiming to freeze these assets. They're also requesting permission to trace the flow of trust funds that were allegedly diverted, with the intention of returning them to the trust accounts from which they were taken. This kind of legal action underscores the seriousness of the allegations.
Indeed, Steve. iPro Realty was shut down by RECO back in August due to what was initially reported as a $10 million shortfall in their commission and consumer deposit trust accounts. However, RECO has since clarified that the missing amount is believed to be less than $8 million. iPro was a significant player, operating 17 branches with about 2,400 agents.
It's a huge operation, Sandy, and the impact on the agents and consumers involved can't be understated. RECO Chair Katie Steinfeld has been clear that consumers and agents placed their trust in iPro, and that trust was violated. She emphasized RECO's commitment to seeking justice and recovering the funds that should have remained in trust.
The allegations suggest that iPro's former principals and other parties orchestrated a scheme to systematically divert, remove, and misuse the trust funds. Dentons Canada, LLP, is conducting an independent audit, and we can expect an interim report by the end of this month. It's crucial that this investigation is thorough, given the potential repercussions.
Absolutely, Sandy. While Peel Police were notified of the situation, the investigation is currently under RECO's purview. The latest legal steps taken by RECO are aimed at setting a clear path for recovering the funds that were diverted or removed from trust. Their priority is to protect Ontario consumers and registrants and to restore confidence in the real estate sector.
It's important for our listeners to understand the gravity of this situation and how it might affect the broader real estate market. The allegations, if proven true, could have significant implications for trust and accountability within the industry. We'll continue to follow this story closely and provide updates as more information becomes available. Our final topic today revolves around a recent statement by Colleen Volk, the President and Chief Executive Officer of the Canada Mortgage and Housing Corporation, or CMHC. She spoke at the Canadian Apartment Investment Conference in Toronto and expressed a desire for banks to take on more risk when funding residential construction. This is an interesting perspective, especially considering the current housing market challenges.
It is indeed, Sandy. Colleen Volk's remarks highlight a critical issue in the housing market: access to funding for new construction. With housing starts in Toronto at their lowest in 3 decades, there's a pressing need for increased residential development. Volk's suggestion that banks could assume more risk in funding these projects might be a potential solution to jumpstart construction.
Absolutely, Steve. During a one-on-one session with Anna Bailão, the head of Affordable Housing and Public Affairs at Dream Unlimited, Volk emphasized that CMHC is under the supervision of the Office of the Superintendent of Financial Institutions, which has recently increased the corporation's capital requirements. Despite these constraints, Volk believes there's room for more responsible risk to tackle the housing crisis.
Right, Sandy. She mentioned that while CMHC has accounted for a significant number of housing starts, it's still not enough. The chief economist at CMHC has pointed out that they're doing only half the number of starts needed annually. This shortfall suggests that additional financial risk-taking might be necessary to meet the housing demand.
And it's not just about the numbers, Steve. Volk also touched on the federal government's plan for Build Canada Homes, which might see Ottawa re-enter the business of building housing. This initiative could complement CMHC's efforts by focusing on deeply affordable housing, an area where CMHC has been less involved.
That's a good point, Sandy. The idea of Build Canada Homes operating similarly to the Canada Infrastructure Bank could mean more flexibility in funding structures and potentially more innovative solutions to the housing shortage. Volk's comments about the false distinction between affordable and market housing underscore the need for integrated approaches to housing development.
Exactly, Steve. Volk expressed a desire to double the funding for CMHC's apartment construction loan program, which provides developers with low-cost loans to build rental projects. This could be pivotal in increasing the housing supply, especially if banks are willing to share the risk.
It certainly could, Sandy. The collaboration between CMHC and financial institutions could pave the way for more housing starts and help alleviate the current crisis. As these developments unfold, it's crucial for stakeholders in the real estate market to stay informed and adapt to these changes.
Agreed, Steve. As we continue to monitor these initiatives and their impact on the housing market, we'll keep our listeners updated with the latest insights. It's essential to navigate these changes with a well-informed perspective.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.